We're hearing about the slump in oil prices. The slump in oil prices earlier on seems to have been just a blip. In fact, now we're seeing oil prices increasing. We're also seeing monetary authorities in China and Europe reducing rates. How much do you think this is impacting our market? Analysts say this has been what's the reason for us seeing our market sort of performing well this week and last week as well.
I think that we've long voiced the fact that this our market now, given the participation mix, given the dominance of the international portfolio investor, the Nigerian market can no longer argue that it's decoupled in any way, and the things that drive global risk sentiment will also have a bearing on the Nigerian equity markets. Clearly, from a sort of a global sentiment perspective, when there is a real concern about growth and just how weak growth may or may not be, then the oil price is one of the key indicators for that. So, when we see the oil price come off, it kind of speaks of negative sentiment, and then it can become self-reinforcing. Now, that is a key transmission mechanism from a macro point of view into the Nigerian economy, because 80% of government revenues and 95% of forex earnings come from that source. So when we saw oil prices fall to around 90, clearly there was concern about how this may impact Nigerian government spending, over the sort of next few months if these levels weakened and were sustained at sort of such levels. The response that we've seen around the world from the ECB, from the monetary authorities in China, indicates that these authorities are watching the situation closely, recognize that they may not necessarily have found a flaw under sort of growth weakness, and they still are ready, willing, and able to take some action to support. The Bank of England also announced additional QE, and I think the expectation that the Fed will do the same has also grown in recent weeks.
So you're saying that this definitely is going to be impacting our markets positively in the long run. But really, I just want to ask, what are some of the strategies we're going to see in terms of portfolio allocation with with the current business environment?
Well, I mean, as far as the domestic investor is concerned, we still think that the environment for rates remains very constructive in terms of higher yields on short-dated government paper. So I don't think that we are yet poised to see a rotation out of fixed income into equities for the domestic investor just yet. We still think that the exchange rate is a priority for the central government, and they still have some firepower left to support it at these levels, even if it means maintaining or increasing rates over the coming months. So this will dissuade domestic institutionals from leaving the fixed income space. As far as the internationals are concerned, what a firm tight monetary policy will mean is that it offers support to the Naira and gives that confidence to come into an equity market that currently has some very attractive valuations. We think that the banking sector will be the chief beneficiary of this, because we've argued that from a bottom-up perspective, things have been strengthening. The banking sector has obviously had a 3-year rough period. We believe that it has turned the corner. Q1 numbers suggested that, and as we see more data from Q2 and Q3, it will indicate which banks are maintaining that strong trend. And given where the valuations are and the relative liquidity of banks versus other sectors, we think that this will be the key play both for institutional and any domestic investors that want to participate in the equity space.
Well, Rele, you said the banking sector will be the chief beneficiary of this. Now, looking at how banking stocks performed yesterday, we saw bullish sentiments was sort of skewed to mid-tier and low-price stocks, specifically in the banking sector. What is your take on what we're going to see, how we're going to see investors playing that sector going forward? Because they seem to be more skewed towards the mid-tier and low-price stocks right now.
I don't think that will be sustained. I think on a volume basis, we may see some interest here and there on the mid-tier banks, but on a volume basis, over time, we're going to see focus on the larger banks. So we're talking about, the first banks, the GTs, the Zeniths, and even sort of the UBA and Access will also be beneficiaries, and to some extent, ETI. So I think that whilst there might be some variations from this from time to time, the overall trend will be towards the larger banks. One, because they have more basic resilience with respect to any shocks that the economy may experience, and secondly, because they offer more liquidity, so that if investors want to reduce positions or exit positions, they have a better chance of doing so in those larger liquid stocks than they do in the mid-tier names. But for investors that maybe want to take a 3-year view, of which those guys are not necessarily the majority, I think that yes, there will be some interest in the mid-market names at this time.
Well, let's turn our attention to other stocks, specifically Dangote Sugar. We heard there was a fire in their refinery on Friday. Analysts speculated how this is going to affect the production of sugar and the distribution of sugar here in Nigeria. Now, surprisingly, I mean, we had the CEO talk to CNBC yesterday. He said this was not going to affect production at all. In fact, they'll be back in a week. And in fact, we saw the stock go up about 1 kobo. What's your take on what's happening with that stock specifically?
Well, clearly, a fire is not a positive thing, but the issue is, how much damage was done, how long will it take them to rectify it, and in the meantime, can they still maintain volumes by selling from what they have in stock? And this is the representation that management has made, so far. I mean, aside from this kind of localized incident, we are relatively bearish on the name at present on a sort of a broader kind of fundamental basis, because we feel that the sector is moving into a season of overcapacity, and it's not clear to us how margins are going to be defended. I mean, obviously there may be some support from movement up and down in raw sugar prices, but in terms of capacity in country and demand in country, we feel that the sector is moving towards a soft patch. Now, this event is not helpful, because there's still some uncertainty as to how much damage was done, how much the insurance companies will pay, and whether or not the company will have to bear any losses. But for the moment, the expectation is that they can continue to meet their orders. From those things that they already have in storage, and they weren't operating at full capacity in any event. So we're not overly concerned about that in the immediate.